Stop what you're doing right now, this second. Put the coffee down, turn the volume up, close the other tabs, sit up straight and pay attention like your financial future depends on it. Because it does. Text can wait. Emails can wait. That person you keep checking your phone for, she will never match you back. Focus. Take a breath. Look at the screen. Are we clear? Good. Because if you own silver or gold, do not sell a single ounce. Do not place a single trade. Do not make a single decision until after you finish this video. What is happening right now in the precious metals market is not normal, not temporary, and not something you can afford to misunderstand. Prices are exploding, spreads are blowing out, and the signals flashing across global markets right now are the kind you usually only see once in a generation, right before the system breaks. Ladies and gentlemen, this is Paper to Atoms. It is January 28, 2026, and I'm about to tell you something that should be mathematically impossible in a functioning global market. Yesterday, January 27, 2026, we talked about stress building under the surface of the metals market. We talked about rising delivery demand. We talked about widening premiums in Asia. We talked about unusual movements in futures positioning that did not match the calm tone coming from the financial media. And I told you that something was about to break. I told you that when physical demand collides with a leveraged paper system, the paper side always blinks first. I told you that if the pressure did not ease, we would see a pricing event that would shock people who still believe these markets are stable. And you know what happened? The pressure did not ease. It exploded. Overnight, silver did not just rise, it launched. In multiple global markets, physical prices disconnected from futures benchmarks so fast that dealers started pulling inventory, spreads widened, and bids chased a market that simply was not offering metal at yesterday's numbers anymore. At the same time, gold surged alongside it, not as a follower, but as confirmation that this is a full-blown safe haven panic, not just an industrial metals story. What we are seeing today is not a random rally. It is an escalation. Yesterday was tension. Today is rupture. Yesterday was warning shots. Today is impact. And here is the key. This did not start today. Today is just the moment the stress that has been building for months finally became visible in price, violently, globally, and all at once. This is the kind of shift that separates people who understand the difference between paper promises and physical assets from people who find out the hard way. Here is the headline you need to understand, and I want you to hear this clearly. Global physical silver pricing is diverging from paper market pricing at the same time gold is exploding toward $5,600. The same silver market, the same gold market, the same global financial system. And yet prices that are supposed to be unified are behaving like they live in different realities. In a functioning market, this is impossible. Silver is a globally traded commodity. Gold is a globally traded monetary metal. Arbitrage, the process of buying low in one place and selling high in another, is supposed to keep prices aligned. If silver is cheaper in New York than in Asia, traders buy it in New York, ship it, sell it, and close the gap. That is how markets are designed to work. But today, the gap is not closing. It is widening. At the same time, gold is not drifting higher in a calm, orderly trend. It is spiking in a way that signals fear, urgency, and capital flight. That combination, silver dislocating while gold accelerates, tells you this is not just about industrial demand, not just about inflation, not just about speculation. This is a stress signal from inside the financial system itself. And I am going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers, because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Yesterday, silver futures in New York were trading near $38.40 an ounce. Physical wholesale bars in major Asian hubs were already commanding the equivalent of $41 to $42 when you factored in premiums. That was the stress signal. That was the warning shot. A few dollars of spread. Uncomfortable, but still within the realm of temporary dislocation. Now look at today. Futures spiked through $44, printed above $45, and physical offers in parts of Asia and the Middle East surged to the equivalent of $48, $49, even $50 an ounce for immediate large bar delivery. Let me say that again so it sinks in. Paper silver trading in the mid-40s, physical silver changing hands near $50. That is not a small difference. That is not a rounding error. That is roughly a 10% plus premium for real metal over the benchmark price that is supposed to represent reality. And it is not just silver. Gold futures moved from the 5,200s into the $5,500, $5,600 zone in a matter of sessions, while physical kilobars in Asia traded even higher once local currency weakness and import costs were factored in. The same pattern. Futures chasing, physical leading, the tail trying to catch the dog. Now, in a normal market, a 10% spread is an invitation. Traders would be lining up to buy futures, stand for delivery, ship the metal, and lock in near risk-free profit. That is how arbitrage closes gaps. That is how price discovery is supposed to function. But the spread is not closing, it widened. Yesterday, the gap was a few dollars. Today, it is pushing toward double digits in percentage terms depending on location and form, bars, coins, wholesale, retail. That tells you something critical. The friction is not price. The friction is access. Let us break this down even further. Spot price, mid-40s. Physical wholesale offers, high 40s. Retail coins and small bars. In many places, $52, $55, even $60 equivalent once premiums are layered on. That is a 20% to 30% premium for small physical compared to the official price scrolling across financial TV. And this is where it gets really interesting, because at the same time this premium structure is exploding, exchange inventories are not flooding the market with relief supply. We are not seeing a wave of metal rushing out to crush premiums. Instead, we are seeing tightness, cautious offers, and longer lead times from dealers who are trying to source product in a market that is moving faster than their supply chains. Three things have happened at once. Exchange prices have jumped, physical premiums have jumped more, and inventory liquidity has not kept pace. That combination is not normal. That combination is what you see when a leveraged paper structure runs into a wall of real-world demand. Now here's the key insight you need to understand. Price alone does not tell the story. The spread tells the story. The distance between paper promises and physical metal is the stress gauge of this entire system. And right now, that gauge is deep in the red. But that is not even the worst part. Now let me put this in perspective because I do not want you to think I'm exaggerating. Markets move. Metals are volatile. Spreads widen and narrow all the time. But what we are seeing right now is not routine volatility. It is structural stress. Think back to 1973, 1974, when inflation was exploding and gold was being remonetized in the public mind. Prices surged, yes, but the global market infrastructure was far less financialized, far less leveraged than today. Arbitrage channels, though slower, still functioned. Think about 1980, the Hunt Brothers era. Silver went vertical, the price exploded. But the dislocations then were driven by a concentrated squeeze and a regulatory crackdown that followed. Even in that chaos, price differences were violent but short-lived because metal moved, positions were liquidated, and the system forcibly reset. Jump to 2008. Financial markets collapsed, liquidity vanished. Gold and silver initially fell in paper terms as everything was sold for dollars, but physical premiums spiked because retail demand drained inventories. That was a preview, a small-scale version of paper price and physical reality diverging under stress. Then 2011, silver ran to nearly $50. Volatility was extreme. Margin hikes hit. Prices crashed. But here is the difference. That was a speculative spike that exchanges were able to crush by tightening financial conditions. The paper market reasserted control. In a normal market, arbitrage is the glue. If silver is mispriced in one region, traders buy it, ship it, sell it. If gold is higher in Asia than in London, bullion banks move bars. The system self-corrects. But today, the arbitrage is dead. Not difficult, not expensive, dead. Can we not ship silver from New York to Asia? Of course we can. Planes still fly, ships still sail, logistics companies still operate, so that is not the problem. Can we not ensure shipments? Of course we can. The global trade system did not suddenly forget how to move cargo. So that is not the problem either. Can traders not see the spread? Are they blind? No. The smartest, fastest money on earth is watching these screens. They see it. So that is not the problem. The problem is that the metal that is supposed to be available against those paper claims is either already spoken for, already allocated, or too strategically important for holders to part with at yesterday's prices. That is a confidence issue. That is a trust issue. That is a system issue. When arbitrage stops working, it means participants no longer believe the other side of the trade is risk-free. They are no longer sure delivery will be smooth, timing will be honored, or rules will not change mid-game. So instead of flattening spreads, they back away. And when they back away, the gap widens. That widening gap is what you are seeing now in silver. That simultaneous surge in gold is the confirmation that capital is looking for safety outside the paper system. This is not just a rally, it is a fracture forming in real time. Now let me tell you what happened this morning that makes today's move even more significant. Because price does not explode in a vacuum. When you see a system under stress, you also see the system try to defend itself. And that is exactly what we got. As volatility surged, the exchange stepped in with the classic playbook. Margin requirements were raised, risk parameters were tightened. Messaging shifted toward orderly markets and stability. the financial equivalent of slamming on the brakes in a car that is already skidding on ice. They did this specifically to slow the rise. They did this specifically to force leveraged longs to think twice. They did this specifically to protect the banks who are short. Because let us be honest about the structure here. On one side of this trade, you have industrial users, investors, sovereign buyers, and physical stackers who want metal. On the other side, you have large financial institutions that have historically provided enormous amounts of paper supply, contracts, derivatives, forward sales that dwarf the amount of readily deliverable metal. When price rises too fast, those short positions come under pressure. Losses mount. Risk managers get nervous. And the exchange, whose biggest members are those same institutions, suddenly becomes very concerned about excessive speculation. We have seen this movie before. Silver Sunday in 2011, rapid price rise, then a wave of margin hikes in quick succession. Liquidity tightened, speculators forced out, price smashed, the paper market reasserted dominance. And for about a brief moment today, it looked like it might work again. Prices wobbled. Some leveraged players got shaken. Headlines talked about overheated conditions. The narrative machine tried to frame this as just another spike that would soon collapse back into line. But then something happened. Physical bids did not disappear, they increased. Dealers did not slash premiums, they raised them. International demand did not pause to let the futures market cool off. It kept pulling. That is the part they cannot easily control. You can change margin rules, you can tweak trading limits, you can flood the headlines with calming language, but you cannot instantly create millions of ounces of physical metal if real buyers want it now and do not trust paper substitutes. So instead of collapsing, the market absorbed the hit and kept climbing. That is a failure of the usual suppression mechanism. That is a signal that the leverage on the paper side is running into a wall of reality on the physical side. And when the usual tools stop working, the situation does not calm down. It escalates. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. This is a global event, and if you only look at one market, you are missing the full picture. In Shanghai, silver premiums are trading at nearly $10 above COMEX prices for immediate delivery. That is unheard of. Buyers in China are paying cash and taking delivery immediately because they know the paper market cannot guarantee supply. At the same time, gold kilo bars are moving at record premiums. This is not speculative behavior. This is safe haven panic. In India, silver has surged toward Rs4 LAKH per kilogram in retail channels, with wholesale prices slightly below that. Importers are scrambling to secure contracts, and local jewelers are hoarding because they cannot meet demand from their usual suppliers. Gold is similarly breaking records, with sovereign demand increasing and domestic premiums widening to nearly $70 per 10 grams over spot. In the West, futures are surging, but physical premiums are smaller, yet still expanding. In London, silver bars are moving at $2–3 above the futures price, which is a huge jump compared to normal spreads. Dealers are rationing stock to prevent inventory depletion. Industrial buyers are also playing a role. Tesla, Samsung, and other tech companies have started pre-buying silver for production. They cannot wait for paper contracts. They want metal in hand. This is driving physical demand even higher and further disconnecting paper from reality. Even the bond market is reacting. Capital is fleeing risky assets into precious metals. Interest rate expectations are shifting. Real yields are collapsing in multiple regions. The interplay between monetary stress and metal demand is becoming a self-reinforcing cycle. So, let us summarize geographically. Shanghai. Cash premiums surge, delivery guaranteed, buyers desperate. India, retail and wholesale prices spiking, import scramble underway. West, futures jump, premiums rising, physical stock rationed. Industrial buyers pre-buying aggressively, adding fuel to the physical squeeze. Now here is the key. The same forces pushing silver higher in Asia are pushing gold higher worldwide. This is not localized panic. This is synchronized, global, and systemic. When multiple major markets are signaling the same stress, it is no longer about timing a spike. It is about understanding that the system itself is being recalibrated under pressure, and paper prices may never fully reflect physical reality until the imbalance is resolved. And that brings us to the trap that most investors do not see. Now let me tell you about the 50+ trap. Because here is where most people get it wrong. They look at the number on their screen, the COMEX price, the Bloomberg quote, the spot price, and assume that is reality. It is not. Not even close. The difference between paper silver and physical silver right now is staggering. You see $44 on a futures ticker, you pick up the phone and call your local bullion dealer. You ask, "Can I get 100 ounces at $44? They will laugh at you. Some might hang up. Others will quote you $52 with delivery in weeks, not days. That is the decoupling. That is the moment where the paper market and the physical market snap apart. This is not a temporary glitch. This is structural. Physical metal is scarce relative to the paper claims. Storage is tight. Shipping is tight. Buyers are desperate. And the intermediaries, the banks, the brokers, the exchanges cannot magically create ounces that do not exist. Let me show you why this matters. Triplet 1, futures say $44, physical wholesale says $48, retail coins say $52. Triplet 2, exchanges report inventory available. Physical dealers report sold out status. Brokers talk liquidity. Reality, metal is gone. Triplet 3, paper contracts can be bought or sold instantly. Physical delivery takes time and cash. The market is bifurcated. This is the trap. The paper price is comforting. The screen says one thing: the metal in your hand costs 20% more and cannot be sourced immediately. Investors who rely on paper-only exposure are blind to the real shortage building beneath the surface. And here is the critical insight. Once a disconnect like this starts, it tends to accelerate, not calm down. Traders chase spreads. Physical premiums rise. Inventory tightens. Fear increases. Every moment the paper market does not catch up, the spread grows. This is why the 50 pluses figure is not crazy. It is entirely rational under current conditions. It reflects a market that is panicking for delivery while the paper system still pretends everything is normal. And that, ladies and gentlemen, is the lie. The illusion that COMEX, silver, or GLD shares represent real ownership of metal when in reality, the risk of delayed delivery and escalating premiums is growing every hour. If you are holding paper, do not be fooled. This is the system setting a trap, and it is a trap that can wipe out anyone who underestimates the difference between numbers on a screen and metal in hand. So what does this mean for you? What should you do right now? Let me be very clear. Time is not on your side. Every hour, the gap between paper and physical spreads further. Every day, premiums rise. Every week, access to metal becomes more restricted. Let's break it down for the 4 possible situations you might be in. If you own physical silver or gold, coins, bars, rounds, do not sell. Do not even think about selling. The temptation to take profits at paper price is enormous, but the real value is in physical ownership. You are holding the scarce asset that the system cannot easily reproduce. Do not let momentary headlines trick you into surrendering your position. If you own silver or gold ETFs like SLV, PSLV, GLD, you need to seriously consider your risk. These products are tied to paper, not necessarily immediate physical delivery. When physical premiums are surging and inventory is tight, your ETF shares may not fully reflect reality. Do not panic sell, but understand what you actually own. If you own metal futures, you need to decide right now whether you trust the exchange to deliver. Contracts are promises. They are not metal in hand. If delivery fails or is delayed, your gains are only theoretical. Decide whether you want to close, roll, or hedge. And do not wait for the perfect price. If you do not own any metal and you're thinking about buying, the question is not, should I buy? The question is, can I still buy at a reasonable price? Physical is scarce. Premiums are surging. Waiting could mean paying a 20-30% premium over paper prices, or worse, not being able to source at all. Let me repeat, this is not financial advice. I'm not telling you what to do with your money, but I am telling you what I see, what is happening in the markets, and what the consequences of inaction could be. The key insight here is urgency. Physical metals are scarce. Paper markets are detached. If you wait for clarity, you might be too late. If you act, you can position yourself on the right side of a market that is undergoing a structural shift. Remember, silver near Rs4 LAKH in India, gold above $5,600 globally, physical premiums exploding. This is a stress signal, and it is flashing red for anyone still relying on paper markets. Time to act is now. Not tomorrow, not next week. Now. Now let me address the elephant in the room. We are entering the final countdown. The system is under strain, and the next 24-48 hours could define the trajectory of precious metals for months, if not years. Let's break this down into phases so you can understand exactly what is unfolding. Phase 1, the last train. Current moment. Right now, physical demand is outpacing supply globally. Premiums are surging. Exchanges are attempting to maintain calm with margin hikes and risk controls, but those are temporary breaks, not solutions. Every hour, the paper market is increasingly detached from reality. Investors who are still on the sidelines are facing a moment of truth. If you want physical, you need to secure it now. Phase 2, the void, market waiting, pause. In the next 24-48 hours, expect market pauses and heightened volatility. Futures may wobble, spreads may fluctuate, and exchanges will release statements about orderly markets and liquidity support. But this is the void, the calm before further escalation. Do not be fooled. During this phase, paper markets will try to reassert control, but physical demand will continue to rise behind the scenes. Phase 3, Silvergeddon, our safe haven surge, the event. This is the stage where the system's stress fully materializes. Physical premiums could explode beyond anything previously recorded. Delivery times could extend weeks or months. Arbitrage mechanisms may completely fail as buyers globally scramble to secure ounces. Gold and silver prices could reprice dramatically, not gradually, reflecting the true scarcity of physical metal. Experts are already warning about $5,800, $6,000 gold in the next few weeks if physical stress persists, and silver has the potential to breach RR 4.55 LAKH guys in India, with premiums in Asia surging even higher. These are not predictions pulled from thin air. They are derived from observable spreads, delivery constraints, and global demand signals. This is not a normal market cycle. This is a paradigm shift. Paper markets, ETFs, and futures are being challenged by real-world scarcity. Those who rely solely on digital numbers are going to be shocked. Those who hold physical are positioned to survive and potentially profit from a historic dislocation. Let me say that again so it sinks in. The gap between paper and physical is no longer minor. It is systemic, it is structural, and the next 24-48 hours will determine how extreme this dislocation becomes. Prepare for volatility. Prepare for price discovery in real time. Prepare for a market that is no longer theoretical. It is physical, tangible, and urgent. So here is my final message to you. The time for debate is over. The time for watching is over. Silver is surging toward Rs 4 lakh kg. Gold has already hit $5,600. Physical premiums are exploding. Paper markets are failing to reflect reality. The numbers are undeniable. The system is under stress, and your next move could define your financial future. The paper market is dying. The physical market, the truth, is taking over. You are holding the winning lottery ticket if you own metal in hand. You are sitting on collateral that cannot be printed, cannot be manipulated as easily, and cannot vanish overnight. Do not sell. Do not let them steal your silver or gold. Do not let them shake you out of your position. This is the moment where patience, insight, and action intersect. The target? Silver could surge past Rs 5 lakh kg in India. Gold? We are watching $6,000 and beyond globally. The timeline is accelerating. The fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you're holding physical and you're not selling, share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this, your financial advisor won't tell you this, but I will, every single day on Paper to Atoms. And here's a question for you. Leave it in the comments below. Are you holding physical or paper? What price do you think silver or gold will hit by the end of February 2026? Comment your prediction. I read every single comment, and I'll see you in the next update. Remember, get out of paper, get into physical. Go, go, go.